Okay, we are live. Appreciate everybody hanging in here with us. This has been awesome to have you here. So excited. Go ahead and put in the comments and let us know who's here. Go ahead and say who you are, where you're from. Love to be able to get a good feel for who's actually here on today. Because we got several of you on live. I know some of you guys watch the recording later, which is great too. But definitely like to do that. Just so you're aware, the comments when you put them in takes like at least 30 to 60 seconds to show up. So I'm going to ask you questions. I might not see it immediately. And feel free, by the way, to ask questions along the way because I will come back to it. So be sure to ask any questions, even throughout the presentation. I'll come back and offer a little bit of Q&A time for this. But honestly, my team's challenged me to do this faster than I've done other presentations. So be sure to hang in because I'm definitely sharing some good stuff. And then we got Christopher from Redondo Beach, California. Welcome. Good to see you again here, Christopher. Jeff from Seattle, or sorry, no, Jeff from Grand Haven, Michigan. We got Terry from Seattle, David from Spring Branch, Texas. Love having Texas. Corey skiing in Colorado. And then we got Roberto from Connecticut. So love you guys. I actually know some of you guys personally. So it's good to see you guys and have you on here today. All right, Patrick from the road. All right. Hey, you're the only one I've seen that's actually ever said that before versus the location. So good to have you on as well, Patrick. All right. So here's what we're going to talk about today is that we're going to talk about this one hack to save years on your financial independence journey. Now, some of you might have seen presentations like this before, but I really want to dig in deeper, but give you like just good bang for your buck. Michelle from Port Townsend, welcome, as well as Marilyn from Fort Worth and Blake from sweating in Louisiana today. I wish I were sweating in Utah today. So anyways, I want to go into that hack right now as we're talking about this, because really we're talking about how do we store your money and actually use this money more productively, where you get higher returns to the banks, but safer than stocks, still tax-free, protected 100% from sue-happy predators and creditors. It builds your family legacy, so it actually passes on something that's amazing. And as we're talking about today, it's a passive income booster that pays you twice, shaving off years towards your financial goals, just like hundreds of my clients have already done, including some of you guys on here right now. This is what we're going to talk about today. So if this is something you wanted to know more about, hang in there. If not, just move on. Some of you guys know this, but this is my dad. This is from me 30 years ago. You can see there in 1994, August 23rd. I was just about to go into my senior year at this time. And and I'm laughing right now because I have people that work for me that got born after this picture. But anyways, he's kind of my inspiration in the sense that he was the reason I wanted to find financial freedom. Not because he was financially free himself, but he was kind of like the poor dad from Rich Dad, Poor Dad. He was the guy that worked his tail off. He worked so hard, yet always said things like, we can't afford it. You know, what am I made of money? Money doesn't grow on trees. And I didn't want to live that kind of life. And that's why I decided, one, to become an entrepreneur. But then two, I even went into financial advising, only to find out years later when I went to sit down with him that it didn't work. Because I sat down with him, he had stuffed money away in his 401k and got the match. He paid off all his debt, including his mortgage. He was totally 100% debt free and putting money in his 401k like every good boy and good girl should. Yet I had to tell him, Dad, if you want to retire today, you better hope you die in about 5 or 6 years, because that's when you'll run out of money. That right there, guys, that's what scared me, because I had taught for 4 years as a financial advisor that everything was going to work. Everything was awesome, right? You know, just like the Lego movie. But it wasn't, because I was selling people on hopium, trying to get people to smoke all this hopium to feel hope, yet none of them were actually seeing it. And when I realized, I'm talking with a friend that when he said, well, how many of your clients are truly financially free where they don't worry about money? None. Well, how many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these same investments? Well, none. There's your problem. And so that's why I went on a journey to try to find the answer. I went to like real estate investing, more passive real estate, which we'll talk a little bit about today. And from there, I was actually able to retire when I was 28, almost 29 years old back in 2006. And that taught me a lot, because I realized that what I was teaching just didn't work. It wasn't right. And so guys, this is the challenge here, right? We got all kinds of things. We got markets that we're not sure going to happen left or right? We got the government that obviously has got all this debt, trillions of dollars of debt that's growing by billions every single day, yet they don't know how to pay it off. Are they going to go for your retirement plans? Is that where they're going to get their money from? Because they can change it on those IRAs and 401ks whenever they feel like. You know, interest rates, you know, we actually are going to be hearing about interest rates tomorrow. They might go down, but what if they don't really go down? What if they just stop after this? What if they say that's enough? Well, interest rates are still pretty high, right? We got that issue. We got Warren Buffett selling off his stocks in Apple and Bank of America. He's already sold them off in the last couple months. Why is he unloading these stocks? And at the same time, you notice the article says 277 billion from October. Well, guess what? Last week, I looked up the article. He saved 325 billion in cash. He has saved $50 billion in just the last 2 months that he's throwing into cash. Why is he storing so much cash? What is he getting ready for? And not to mention, we got bank failures happening left and right, and of course, we're not sure what the feds are going to do with that, or if they're just hiding something. We just don't really know, right? And so I want to talk about something that actually has been proven to work for decades. Something that actually has been used by guys like Walt Disney, where he was actually able to get the financing from ABC. Funny enough, that's why ABC and Disney are all been in partners together. They put up a lot of the money, but he had to put up some of his own money, including the strategy I'm going to talk about here to create the happiest place on earth with Disneyland, right? We got Ray Kroc, who when he bought McDonald's from the brothers, he had to keep those executives on board. He used this cash reserves to be able to do that same thing. And of course, where do banks store their money? Guess what? It's not the bank. They store it somewhere else, right? They store it somewhere else completely. In fact, by the way, I actually had a friend that I interviewed to go on my podcast. He'll probably come out in about a month or so. My friend actually even said the reason that he started looking at this strategy more was because his friends who owned a bank refused to put money in their own bank, but put it into here and doing what we're talking about here, which is infinite banking, right? Now, I know even if you've heard about infinite banking here, right? I'm going to take a little bit different slant with this. I'm going to take a kind of a more of a bigger picture view of how this works, because this alone will not make you financially free, but it's a tool that can actually get you there faster when used appropriately. And by the way, you don't have to become an expert. You don't have to use this all the time. It's not something I expect you to use on a daily basis. It's actually something you can do very simply, but use it to enhance what you're already doing. Now, here's the kind of real secret. If you really want to create financial freedom, first and foremost, one, it starts with education and your mindset, especially the mindset around money. If you're stuck in a saver's mentality, you will always be stuck being broke like my dad became, right? Like what happened to him, where he had to work into his 70s to finally retire, really with 10 years or less, right? I mean, think about it. You work for 40, 50 years to then finally live maybe 10. Does that sound good to you? No. So this education, you got to have a different way of not just viewing money, but a different way of using money so that you can actually get it work better. Use this max ROI infinite banking strategy that we talk about using in coordination with getting passive income investments. And what you'll see happen is that you will get to financial freedom even faster than those that just talk about using only passive income investments. And I'll show you how that works. Now, just so you know, the Dave Ramseys of the world, they don't get it, right? Even they've been asked about it, they don't really care to understand because they just block their minds off and just say, well, it's all crap. Well, I'll tell you, the majority of infinite banking strategies and policies that are out there, because it is using a whole life insurance policy, I will tell you, most of them are crap. And so he's right. But there is a way to make it work much better than even the strategies he talks about for himself. And I'm not alone. I mean, we had Eddie Wilson on our podcast last year. You guys know who he is. He's a rock star. Awesome. I mean, this guy has bought and sold many businesses in the tune of hundreds and hundreds of millions of dollars. And guess what his own family taught him? This same strategy. And by the way, his grandpa was actually a president of a bank and was the one that started teaching his family and Eddie this very strategy. That's why Eddie is such a big fan of doing it for himself, using this money as seed money and money to use to help buy and sell a lot of these businesses. Now, not all infinite banking is made equal. As I mentioned, most of them are crap out there. Now, that some of them are okay. They're not bad, but it's kind of like you get good, but you don't get great or the best. Right. And there's a lot of good infinite bankers out there. There are good people with good-hearted people. However, that's how they make their money. They do not think like investors or business owners. They think like insurance agents. And as a result, charge you way too much in fees. And that is why it gets a bad rap. Becoming Your Own Banker is a great book if you're trying to start out to learn the different kind of this basic strategy. I will say this, though. One of the myths, use this as a bill pay account. We are not talking about that at all. I do not agree with that. I do not agree you should be buying your own house to then try to pay off your house with this, or even trying to pay off cars with this necessarily. Not really. I use this in a very different way that helped me create financial freedom faster. Now, I first learned about this actually, as I mentioned about my dad, right? After I sat down with him, I was pretty frustrated because I realized my clients were financially free, financial advisors aren't financially free, and I was on the path to not becoming financially free. So I started looking at things like real estate investing, doing more passive investments, creating passive income, getting my money to work harder for me so I don't have to work so hard for it. Now, as I did that, all these real estate investors were raving about this infinite banking strategy. Never heard of it before, even as a financial advisor. So I decided to learn about it more, right? I went to the agent they all recommended and I ended up buying the policy. I said, okay, this looks good. But I asked him, I said, listen, this looks really expensive. I see there's a lot of insurance costs coming out. Aren't there levers we can pull like I can do with other insurance policies where I can pull different levers and make this better, perform better? And the agent said no. Well, 2 years later, the recession hits. I go from millionaire to upside down millionaire. And the next thing you know, I'm in the hole. I'm in the hole 15,000, 16,000 a month. I can't keep paying my bills, including I had paid already up to this point 25 grand into my policy over the previous 2 years. Now, I was at the point I couldn't keep afford paying the premiums. I asked the company, can I stop? They said, no, you have no tax-free savings account here, no cash value, as they call it, right? It's not just a death benefit, but it also has this cash value, this tax-free savings account component to it. That was the part that I wanted to have a bigger number on, but the agent told me I couldn't do it. You had to wait. It's more expensive up front, but it's cheaper over time. Well, I was in that expensive part of the policy, those first two, now going to that third year. There was no money to cover those premiums to keep it afloat. And so I lost the policy. Now, months later, I'm talking with a friend of mine. And as we're talking about this, he said, and he bought a policy from the same guy. He said, hey, did you know you can actually pull some levers to make it cheaper so you actually have cash in the first year? I said, dadgummit, like I knew it. I knew you could. He said, yeah, no, you totally can. Watch. And so we started playing with numbers and doing stuff. And over the next few months, I realized that that insurance agent lied, that he could have done it better, but he didn't. So I actually had a 2-hour debate with him in his office. I was running numbers. I ran my own numbers this time. Instead of trusting him, I ran my own numbers because I still had an insurance license. So I ran my own thing. I showed him I could beat all of his numbers. And at the end of the conversation, he finally just said, Chris, I did that way because I could not afford to cut my commissions. I said, there's the truth. And there's a reason why I will not send you a single family member or friend ever again. And so guys, over the last now going on, this has been 16, going on almost 17 years. God, that makes me sound old, doesn't it? Really, I've been trying to perfect it to the point where we got it dialed in to where we get the max ROI possible in every single policy, no exception. Doesn't matter if you're putting in lots, millions of dollars or a few $1,000s, we can do it where it performs better, and it actually makes sense. And that's why I've been really trying to be this advocate to teach to do it right. This is why we even started doing it inside our own company, because I couldn't even find my own friends who I would trust to do it. I couldn't trust them that they would do the best job for you every time, even when I would send some of you. And some of you, by the way, on this might have been sent to some of these friends in the long past. And now, of course, we find out that's not the case. So anyways, long story short, we got to the point where we brought it in-house in 2017 and make sure that you get the best ROI every single time, no matter who's out there. People do not beat our numbers. They might match it on a rare occasion, but they never ever beat the amount of ROI you get on these kind of policies, which makes them make more sense versus just being an expensive thing that distracts you from making more passive income. Hopefully that makes sense. That's one reason why I call it no BS infinite banking, right? All right, now let's talk about what this really is. What are the benefits I'm talking about here? Why am I using this? Why don't I just use a high yield savings account? Why not just use CDs? Like I was on a podcast just before this talking about. Well, here's one reason why. One, it's tax-free now and later, much like a Roth IRA, but unlike a Roth IRA, there's no 59.5 rule. I actually have no limit to it. I don't get kicked out because I make too much money. I don't have the issue where, of course, you can only, if you pull out before 59.5, then you have a 10% penalty. None of those penalties exist. There are no limits. You can put in up to 25% of your stated gross annual income. So if you're a business owner, even if your tax returns show less, but you make a higher gross amount, you can actually save up to 25% of that gross amount, not off your tax returns, but actually off reality. That even includes if you're making money off of real estate investing, everything else. So if you make, say, $200,000 a year, you can save $50,000 a year in this. I had a client who was a real estate investor making about $1 million a year, packing away $250,000 a year. But yeah, I've got other people that might put away a few thousand a year or 5,000 or 10,000 a year, right? This is also this money in most states in the United States here. I'm talking to those of you in the US. This is 100% protected from lawsuits and creditors, meaning you can have millions of dollars stored in here. And even if you get sued, they can't get to it. They can't touch it. Also, it's safer than the bank. They actually have better safeguards than the bank does. More bank failures happen than you ever see with the insurance companies. And And even then, the minimum guarantee is like 3%, but they're paying around 6% right now because why? Those interest rates are higher. By the way, it's good if they don't actually lower interest rates. Even though you don't get cheap money from the bank, guess what? You get paid more. It starts putting into the 6 to 7% plus range if interest rates stay higher. So we like higher interest rates for that reason. That's tax-free money. It's coming to us. And it's still, as you see now, not just protects your family and has this death benefit part of it, but it has access to cash now. You can use this as a high yield, tax-free savings account that again allows you to get higher returns than those high yield savings accounts, and it's tax-free. Now, who's this not for? There's really 3 reasons I would say this is not for somebody. 1, you're in bad health, right? If you're in poor health, maybe you had, Starks, heart attacks or strokes. I just try to throw that together. Starks, if you got any of those situations, definitely that's an issue. If you've had maybe had suicide attempts, obviously they don't want to cover you in those cases. Things like that, right? If you've, cancer or whatnot, something that's deadly or terminal, it probably will prevent you from getting this. Or maybe you're just in really, really bad health with different diseases, maybe diabetes or whatnot. By the way, even if you have type 2 diabetes, you can still qualify to get this if it's under control. So that is one thing. So if you're in bad health, 1. 2, you're over the age of 70. Although you can still get insurance, this strategy that we're talking about won't work as well. But if you're under the age of 70 or about 70 or under, and you're in at least average health, this could be a good strategy for you. Because I know one of you is going to ask that. Well, what if I'm 65? Yes, under the age of 70 is still 65. Yes, you're still getting. What about 55? Am I too old? No, because I'm almost 50 and I'm not too old. This still works great for me. Okay, so under the age of 70 works great. Also, if you're paycheck to paycheck, this is the 3rd thing. So 1, bad health. 2, over the age of 70. 3, if you're paycheck to paycheck, where you really literally cannot save any money, then just buy term insurance, right? Just buy cheap term. And that's something that we still do too, because you can buy what's called a convertible term policy that can later convert when you do have more cash flow to a whole life, and you don't have to requalify your health. Did you know I actually had a woman who she was in perfect health the year before. The next year, her husband wanted to get her a whole life policy. We tried to apply for it separately, and guess what? The whole life policy, the insurance company came back and they denied her. They said, "Hey, we saw some stuff in her medical records last year that makes us nervous. We don't want to give her a policy." However, I forgot we bought a convertible term policy the year before. So that same exact day they denied her, I went back to them and I said, "Listen, we want to convert this term to whole life." And guess what? They approved it the next week at the highest health rating. Even though they knew her current health situation, they could not deny her getting that coverage because they had a convertibility clause. So we were able to get her that. So, even if you're paycheck to paycheck, term might be a great option. Also, if you're not in great health, do you have a family member that's in good health? I had one guy that was in his mid-50s, horrible health, overweight. He knew that even if he got approved, it would be very expensive, but his wife was in perfect health and even younger than him. We got a policy on her. He's now dumping in like $110,000 a year into her policy. And that's money that's been safe. Even though he's been sued recently, he's actually had that money saved from those losses of creditors too. So there are ways around this. And yes, you can buy on kids, you can buy on grandkids, business partners, and so on and so forth. Now, ways to use this policy. This is where it gets to be fun, right? This is what I want to spend some time on. 1, it could be part of your emergency fund or even your business reserves. Now, I know somebody asked, can it be tax deductible if you're a business owner, right? I'll actually bring that up right now. I'll answer your question right now, Antonio. Can you design a policy to make it tax deductible? If you're a business owner, can your LLC pay for the policy as a benefit to the managers of the company? The answer is technically yes, Antonio. You can buy a policy where the business is the owner, but you lose the tax benefits on the back end. So the tax benefits do become taxable because you got the tax break up front. So kind of like an IRA, right? If you get a traditional IRA, you don't get the tax taken out in the beginning, but when you cash it out, you do pay taxes later. Same thing. This is more like a Roth. You pay with after-tax dollars. It grows tax-free, comes out tax-free, but plus the death benefit also goes to your family tax-free too. So that's another benefit as well. So yes, can you do it? You can. You can buy it on employees even, or key employees and whatnot. But just know you do lose some of the tax benefits, even though you get to write it off initially. Can you use this business funds or reserves? Yes, or even just emergency reserves. So in my family, we want to keep about 400,000 liquid and available just in case the world blows up or whatever, right? Now, if I kept in the bank earning 0.1% at my credit union, that means I make $400 a year, and then I pay tax on $400 a year. So really, I might walk away with less than $300 a year. But Here's what we did. I kept some money in the bank, local bank earning that 0.1%. Yes. We did do some high yield savings accounts that's paying about 3.5 to 4% right now. Rates have come down a little bit. But I get taxed on that money. That's about 100 grand total between those two. The other 300 grand sits in my account earning tax-free 6% dividends. That means that 300 grand is earning 18 grand a year. So remember, I talked about how do you get your money to actually work harder? This is a perfect example. Even if I have money sitting on the sidelines, and I've got a lot of friends who are doing this. I have a lot of business owner friends, especially, that are keeping millions of dollars literally locked up here because one, they know it's protected, but two, they also know that it's going to earn way better return than any kind of money market, CD, high yield savings account, and they don't get taxed. It's one less tax form to deal with too. Same reason I'm doing it. And so I'm storing more and more cash in these than even in past years because I'm realizing this is the one place I can actually fight inflation, where savings accounts really just lose inflation every time. I throw it in the stock market, I could lose up money at any time. I throw it in real estate, it gets locked up. I love real estate investing, but I like to have liquid cash. And if you're a business owner, you especially need liquid cash reserves. So I keep the lion's share of my cash reserves right here. Collateral. You can actually use this money as collateral. This is what Walt Disney did with Disneyland. So see, he actually did, sell off one of his investment properties, his vacation home. He sold that off to get some cash. He also got a $50,000 line, like collateralized line of credit against his life insurance. Because remember, this tax-free savings account in here, this cash value is guaranteed to always make money. Banks love using as collateral because they know it will never lose money. You try to use your stocks as collateral, your brokerage accounts, they don't like it as much, will they? They might collateralize like 50% of it maybe, or maybe a little bit more, but they don't like to collateralize all of that money. So just like one of my clients, he was actually buying a building to purchase for his practice. He was a doctor, and he said, I'm thinking about just cashing out this 300 grand of my life insurance, canceling it, just taking it out because I don't care about the life insurance, the death benefit. I'll just cash out 300 grand and maybe I can just have a free and clear property. And I stopped him. I said, listen, before you do that, let's talk to the bank about some options. Let's see if they'll use this as collateral. I mean, you already have the building as some collateral, but he wanted to get an extra 75,000 out to build it out a little bit more and then rent it. I said, well, what if we ask him about using this as collateral, using the life insurance as collateral instead? So he did. He went to the bank. They said, yeah, we'll do that. And we'll drop the rate down over 2%. So he got dropped down on a building loan to 3.75%. His payment was like $1,800. He got the money for the build out. He was able to do that. The renter then could pay more than his $1,800 a month payment. So he's essentially using his practice rent free. And then of course, a year and a half later, he goes back to the bank, says, hey, can we take the lien off my life insurance now? And they said, yes, because now the value of the building's enough. Yes, we'll take the lien off. So huge. You can actually use it as collateral. You can do this with savings accounts, but you don't get as good rates, as utility of it as much. Extra retirement income. A lot of people talk about using this as a way to retire early. Yes, you can use your 401ks and IRAs and even Roth IRAs. But remember, the timeline for that is after really the age of 60, if you're going to be using that money. What if you have tax-free retirement income before the age of 60? What if you want to retire sooner? What if you don't want to wait that long like I didn't want to? This could be extra tax-free retirement income you use while you're waiting for that Roth IRA or the IRA to finally be accessible without getting slapped with penalties. And some of them will, of course, tax you, but at least this is tax-free retirement income you can use at any age. So huge benefit there. Kids savings. More and more people are hating their 529 plans, their college savings plans, because they realize that the savings they have there, the market could go up or down. Imagine the market tanked like in 2022. If your kid graduated in 2022 and then the market tanks, and even if you had 4 years saved up, all of a sudden you found yourself with 3 years of money. Even the market came back, which it did eventually, right? Even as it comes back, the problem is that if you're pulling that money out, you now have a lot less money than you thought you would have because now you're pulling out dollars that were depressed. What if that were to happen again in the stock market? Not to mention, you don't really get to pick very easily where you get to invest that money anyways. And what if your kid goes to college, but they get a full ride scholarship? Now you don't need that 529 plan because you can only use it for college. And if you don't use it for college, they slap you with penalties. What if your kid doesn't go to college? What if they become an entrepreneur like I did? I dropped out of college. I had some student loans, but I dropped out of college eventually and became an entrepreneur. What about that? Now you get slapped with penalties again? Why would I want that? So this is what people use to say, I can use this money for whatever I want. You can save it for your kid. You can even use the kid as the insured, but you own it. So even if they turn 18, it's not their money. It's always your money. The only way the kid could ever get this money or even know about it for that matter, is if you gift it to them, if you turn over ownership to them, which you could actually do. Imagine this. Imagine if you waited till your kid was older. Maybe you could use it for college, but what if you use it when they're older? Maybe when they're trying to buy that first home that right now Gen Z and even millennials are having a hard time affording. What if you can give them like the extra leg up when they get married and say, listen, I've actually been storing this money up for you. Merry Christmas, Happy New Year, whatever you want to say, right? And you can turn that over to them to then use. By the way, we all know that if you try to turn over money to kids when they're like 18 years old, not the best idea. What if they're in their mid to late 20s, maybe their 30s? And then you say, hey, I've built this cash up for you. You now can use it to help get your family a head start. Maybe the head start I didn't have personally when I was trying to build my wealth. Awesome, awesome way to do it. And you don't have all those dumb rules to follow. Cash flowing investments. Let's talk about this. So this is where it gets to be a lot of fun. Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. Well, let's talk about this double arbitrage. First off, what's arbitrage? Arbitrage is when you go into a bank and you see on the reader board, it shows you, hey, you can get that 5-year CD at 3.5%. And then you look at the other board that says, here's a 5-year car loan at 7%. And you realize, oh, that's where they make their money. They pay us 3.5%. They turn around and loan it to make 7%, but they don't make 3.5%, do they? No, they make double the interest. They make 100% rate of return off your money. That's arbitrage. I love using cheap bank money. This is why I get mortgages when I do investments. This is why I actually even finance my car at 3.99% because I know I can make more than 3.99%, even though I could pay the car in cash. Same thing here. You have the ability to create extra arbitrage using this policy. How? So see, most people when they invest, they just pull the money out of savings or checking, invest it, and then the cash flow comes in to then replenish their diminished savings account, right? So if say you had, $250,000 in your savings account, you pulled it all out to go and invest it. Well, now there's no money in that savings account. It's earning zero interest, even though it's paying you piddly anyways. Now you're feeling happy because at least you're making money with that. But what if you could have a savings account that didn't require you to pull the money out, but you could still invest that $250,000. So the $250,000 is still in there earning interest while you're also got a loan from the bank to then go and use that money to make cash flow off of as well. That's what you can do with life insurance. Instead of using your bank savings account, what you can do is, and you can withdraw money out of this cash value account, this tax-free savings account in life insurance. You can withdraw the money. But the reason we don't like to do that is because if you instead get a collateralized line of credit, remember using this cash as collateral, you can use it with the bank, but right now the insurance companies are cheaper. You get that line of credit from the bank or from the insurance company. The insurance company will charge you interest. Just so you're aware, there's a lie out there that says you pay yourself back interest. That's a lie. You do pay them interest, but their interest is about the same as what they're paying you. It's roughly about the same rate. But I'll show you here in a little bit why that, even if it's the same rate or even if they charge you a little bit more, you actually still come out ahead. Because now they're giving you this line of credit to use this money. Just so you know, this line of credit, you pay it back however, whenever you want. There is no minimum monthly payment like you get with any kind of home equity line of credit or anything. This is a private loan. It doesn't show up in your credit report. Doesn't even require good credit. You don't even have to tell them why you're getting the money. You literally can use this money for whatever you want. That money you're able to get usually within about a week when you request it. It usually shows up in your account, electronically transferred to your account in about a week. And then you can use that money to invest. Now, when you take the cash flow, what you're going to do is take the cash flow and instead of just putting it into, just into a savings account, we're going to use this to pay back that line of credit. And as you pay down that line of credit, you get charged less and less in interest because you only get charged simple interest on that money while they're paying you compounding interest on that money. Or in other ways, you can kind of see it like this. Compounding interest, the interest curve looks like this. It goes up more and more each year. While when you pay simple interest, like on a loan, as you pay the loan balance down, you get charged less and less in interest. So in other words, we're using the cash flow from that investment to pay back that loan, which then frees up that line of credit to then, once again, use it again to go and invest. So let me give you an example. Say you had a small apartment building using that $250,000 down payment. I'm going to compare using the savings account where you drain the savings out, right? That $250,000 versus using your life insurance. And I actually used my own policy. Just so you know, I'm in my mid 40s, soon to be late 40s. But when you're using that money, I actually use my own numbers here. This will show you right here. If you were to do that, making that say their $2,500 a month cash flow to replenish your savings account, your bank savings account, you'll in 9 years put in $270,000. But after you pay taxes, if you only earn that 0.1%, like my credit union's paying me right now, I would only net $1,228 of interest over those 9 years. Just curious, anybody excited about that? Probably not, right? Now, what if I use my life insurance? Even though I'm paying interest and I'm factoring interest costs coming out from the insurance company, and I'm factoring the fact that there's still insurance costs coming out too, because remember, it's an insurance policy. It has a death benefit that helps my family, right? So I'm still paying for insurance technically. It's not like a typical savings account where there's nothing coming out of it. There's money coming out for insurance costs based on how we design it, which is minimal. And there's still interest being charged. And watch what happens after 9 years. Here's the net return you get on that money. 126,000. Now, for you guys, if you're still hanging in with me, which I see more of you jumped on since we started here, I want to ask you a question. Which would you prefer to have? $1,200 interest or 100 times that? I know it's a tough question, but I imagine some of you guys are going to put in the comments here pretty much like, yeah, it's a no-brainer. I want the 126 grand, right? That's net profit. That, if you understand that right there, you will now understand how you can shave off years towards your retirement, towards your financial freedom journey. Because if your money can now work harder by working in two places at the same time, because you're still earning money, that $250,000 never came out of your life insurance. It was still there earning compounding tax-free interest. But you got a line of credit from the insurance company. Remember that with no minimum monthly payments, they charge you interest, but because you're also getting paid interest on money, compounding interest versus now you're paying simple interest on the loan, they are different. What happens, you come out with a net gain on the interest that they're paying you versus what you're paying them. And of course, you're still making the cash flow. You still have the investment too. So you get all the benefits right there. By the way, if there's tax benefits like tax write-offs, depreciation, things like that, you get all those write-offs. See, you lose some of that if you just try to use an IRA. If you just try to put money in an IRA or do a property in an IRA, you don't get the depreciation, that kind of stuff. You have your money just locked up and it gets taxed later. This is why many times if people want to invest in real estate or invest in businesses, I suggest don't do that with an IRA. Use this instead because you get to keep all of those tax write-offs. So that's what we mean about making money twice, right? If you got a fever, you want more arbitrage, this is the prescription right here, right? So coming back to this wealth wheel, again, understanding this stuff, understanding how money really works and how you can make more with it. Using the Max ROI Infinite Banking is a way to store your money, a great way to store your savings for both liquid stuff to make more interest on the liquid savings you're going to have sitting on the sidelines anyways, and can even be used to make money in two places at once when you do your passive investing. That's where you shave it off. And by the way, we do have a free consult coming up. I'll give you a QR code for that as well. Let me answer this. How are the best ways to fund this? And I've debated this over the years. Here's what I've come up with. I think is the best way to do it. Years 1 through 3, don't even use the money you would use to invest in the beginning. In fact, I wouldn't even recommend investing with this in the first few years anyways. That whole double dip, that double arbitrage I talked about, I wouldn't even use that strategy for the first few years. Just understand how it works. Watch how it grows and how you have the savings accessible. And to fund it, instead of using the money you would be using to invest, just use your emergency fund, just like I did, right? Move your money over from your emergency fund into here, just like you're moving money from a lower returning savings account to a higher yielding savings account. Do that in the first few years. This will diversify your savings. It will lock your money in a safer place because if you do get sued, they can get to your bank account, no problem. But do that for the first few years. And by the way, at the point when you get to about year 3 or 4, it's already the policy is now having a net gain by this point. So any money you now put in, you're able to access and take right back out again. And that's why I say years 4 plus, build this, and then you can use it for investments. So here's what I mean by this is that if somebody had, say, that $250,000, I don't want them doing what the many infinite bankers will teach, which is, well, hey, just take 100,000 of that $250,000, throw it in here. But guess what? Even if you do it well, right? And we do it really, really well. The most expensive years are those first 2 years. Year 1, about 20% or so will come out in costs. So if you put in 100 grand, you're going to have 80 grand left after they pull out the insurance costs. That means you now no longer have that 250 grand. Now you have really 230 grand because you have the 150 in the savings, 100 now turned into 80. You now have only 230 to invest. So I always tell people no, don't use the investment money. In fact, go and invest that full $250,000 now, create the passive income. That'll be used later to fund your policy down the road anyways. And maybe you won't do a 100 grand policy. Maybe you want to do like 25 or 50 grand a year in that scenario, right? But guess what? Is you're making passive income, that passive income now pays for your policy, meaning it's like zero net out of pocket by the time you get to that year 3 or 4. Does that make sense? That's a kind of a cool hack that I've learned with infinite banking over the years that really makes it feel like there's nothing really coming out of your budget. Now, you still could do that. If you're already saving money anyways, I've had a lot of people stop funding their 401ks, use this instead. Great, do that. But I love just to use that emergency fund. If you have an emergency fund, if you don't, well, then we better start building that emergency fund, and this could be part of that, right? But use your emergency fund to fund it in the beginning when there is a net cost, and then eventually by that point, when you're a few years in, while you're already investing for those few years, then using that money, the cash flow and the investment returns you're getting from business or your investments, using that to keep funding the policy as years to come. So another way to look at it is this way. 1, you open a policy. 2, you fund it with your savings for those first few years. 3, as you get into those later years, invest it for passive income. 4, use the cash flow from those investments to pay down that loan. And so then you can gather and make money in 2 places at once. And that's where you can become work optional. That's why I don't like to say just retirement, because some of you guys don't want to retire, just like me. I try to retire and it's boring as heck, right? It's horrible. And so I want to keep doing something that I love. And this might be something that allows you to keep doing your passion project and doing whatever you want. Maybe keep doing your job or your business because you love it. But isn't it awesome to know that now you've got enough passive income coming in that you work because you want to, not because you have to? By the way, I've had so many dentists and chiropractors tell me that over the years, that that's their dream. They don't mind practicing, but they want to be able to work because they want to, not because they're forced to, because they're trying to pay for their family's bills. To give you a real life example, here's one of my clients that did this, not using a lot of money. He was only funding like $15,000 a year. I have clients, like I said, some will do hundreds of thousands a year. Some do, 3, 4, 5,000 a year into these plans, right? He was doing about 15,000 a year, but he was also trying to buy 1 or 2 properties. And so he gave me his game plan. He's like, Chris, here's where I already am so far. Here's my plan with my money. And he's like, I'm trying to get to 5,000 a month of passive income. And I want to do it by the time I'm in my early 30s. Now, when I looked at it, I said, well, I'm looking at I ignored the top part. I ignored the top section there that you can see there, but I was looking at the bottom. I said, well, it says you're only at 4,400. You're not at 5,000 yet. You need at least another year or so to get there. He says, well, no, Chris, notice at the top, I'm also taking off that tax-free retirement income from the life insurance. Remember, I can do that, which I just taught you guys. I said, oh yeah, that's right. You could use it that way. Because I've always thought of it as just a place to store my money. I'm not even really using it for my own tax-free retirement anyways. He's like, no, I just take out the other difference, the 950, and I'm over 5,000 by 2029. So that's where you can use it 2 ways, right? Obviously, he's using it to buy properties, but he's also been using it to, of course, and he's using the cash flow also to buy more properties too. He's reinvesting his cash flow to do that. But then he's also got the life insurance he's been using to fund as well that actually helps bump up that income. All right, so here's a QR code, guys. You can scan this. If you've got, if you're on a phone, do a little screenshot, or if you're on your computer, take a picture of it, and then you can go right to the consult. Actually, I don't know if you're on your phone, you might even be able to click on it or do something. I'm not tech savvy. I can't tell you how to do it, but this is how you can book a free consult to see how it would work in your situation. Again, I would suggest if you think you can save at least 5-10 grand a year. Also, if you're in a situation where you're, again, at least in average health and you're under the age of 70, this could be a good option for you. If not, maybe this is something that maybe you know somebody that might be a good option for, right? All right, so I'm going to move along. By the way, just so you know, anybody who sets up a policy with us also gets free access to our Wealth Accelerator Academy. This is actually the stuff we teach about passive investing. It's our online interactive education program that we have where, we do a little bit of group coaching in that once a month, but there's plenty of modules and lessons to help you prepare and be able to learn, hey, how do I find these investments? How do I free up money in cash flow, save money in taxes? Especially if you're a business owner, you need that. How do I pay off debt better? How do I, invest? How do I do the right due diligence? We teach all that stuff in there, and we give that for free for anybody who's actually there with, that's one of our clients that get a policy with us. I get this question a lot. Why not IULs, Index Universal Life or Universal Life? One, because that double dip where you make money in 2 places at once does not exist. There are a few percentage that do, but usually even when we run the numbers, they're not great. They're usually more expensive anyways. Also, costs go up every year, where whole life insurance goes down in cost as time goes on. Costs in universal life go up. They're like buy term, invest the difference. The problem is with term insurance is the older you get, the more expensive it gets. So the costs go up, which means that because there's no certainty and they're based on like the S&P 500 or whatever, if the market goes down or doesn't perform as well, guess what? The numbers are all thrown off. In fact, I used to sell these things over 20 years ago. But every time I would train insurance agents, they would ask these kind of questions about, well, what about this? What if this happens? What if this happens? What if this happens? I had to keep saying, well, yeah, if that happens, then this wouldn't work very well. And I had said that so many times, I started to doubt this very strategy, even though I was using it before most people were been using it lately. The reason it's more popular lately is because the S&P 500 has only gone down once in 15 years. So it looks amazing, but don't expect ever that you're going to see the stock market go up for almost 15 years straight, right? That's very, very rare to go up from 2009 till 20 through 2024. The market's gone up for every year except for 2022. That's never has really happened in history like that. So don't count on the next 15 years to look like the last 15 years. That's another reason. So these things usually don't work great. And by the way, even when we compare, we blow them out of the water anyways, because they got all these extra surrender fees and stuff that people don't like. I actually have a client right now undoing it because somebody had sold him that kind of plan. And then he realized for 4 years, he would have zero cash that he would have access to. All of it was locked up in the insurance company. So definitely I'm not a fan. And by the way, even people that are infinite bankers, here's a Northwestern Mutual policy that one of our clients sent over. We destroyed it. Notice that we're putting in 20, if you can see it, it's really small, but this is showing you putting in 22 grand a year for this particular client. In the New York Life policy, less than $1,000 is in there. It's like $400. Our policy is like $17,000. That's how much in fees he's saving just in the first year alone. Not to mention saves him tens of thousands and even into the hundreds of thousands as time goes on. That you should not be doing. This client right here is actually a dentist. I didn't want to replace it. Yeah. Here, I'm going to put this one up because, you know, I agree. IULs do stink, right? So, but anyways, this dentist actually had infinite banking plans, and I thought it was going to be fine. There were older plans. I didn't want to mess with them. He says, well, can you double check? Now they're putting 150 grand a year, found out that they were that even if they had to start brand new with new fees going to our policies, we would still beat it apples to apples by $2.25 million in just 20 years. That means we're essentially saving them $2.25 million in costs versus the gains they can now have. $2.25 million. Can you imagine? Again, shaving off years towards your financial independence. If you have $2.25 million, do you think you can have financial independence a little bit more accessible? Yes. So this is the cost. This is the big cost that people don't realize, especially when they go outside, trying to use outside sources. Every single time they come back and say, I just overpaid. I got ripped off. And it's not because the agent's evil, right? It's not that at all. It's just, one, they don't know how to do it right because they don't know which levers to pull, or two, their commissions are based on it. And so they say, well, I'm going to pull a few levers, but not all the way because I still want to get paid as well. Again, they don't look at this like they don't design this like they would for themselves. In fact, by the way, we've actually had agents tell us, oh, I'd do it totally different for myself than I would for my clients. Why? Because again, they want to pay the last cost, just like you should. Shouldn't every policy be made just like you were the agent? Yeah. I've had other clients, I asked them, I said, hey, why do you use this? Neil on the left here, he says, less risk exposure to banks and creditor protection. He wants to be protected from those lawsuits and so forth. Ron said, he's like, well, one, I want a place to store a large amount of money that's better than and safer than the bank. And then two, he's like, really, banks have failed where insurance companies have not failed like that. This guy, actually, we're having his podcast come out next week. Chris Waters, he talked about it. He said, hey, my only regret is that I didn't do this earlier. I wish I would have learned about this earlier. Buddy, Chris, I get it. I wish I had learned about it earlier and known about how to do it better too. Dan, he's actually in his 60s. He said, hey, I do it for the double dip, right? I do it for that double arbitrage because I love doing that. And, you know, it's a great place to store money. So here's the thing, guys, you can unbank yourself. You can get away from using the banks. You can do something better with this money. Now, notice I didn't talk about the death benefit. What about that, right? We've been talking about the living benefits for so long. We even talk about the whole death benefit, which is what life insurance is supposed to be about, isn't it? Well, here's the thing. You guys might know this guy, John D. Rockefeller. This guy was wealthy as wealthy can be. Now, he set up a plan that was a little bit different. See, he wanted to make sure his money never ran out. He created a Rockefeller Foundation. Now, he did have support his family, but the great thing is the Rockefellers still have money to this day, as in contrast to the Vanderbilts, who ran out of money by about the third or fourth generations. Now, if you don't want to run out of money later on, one thing you can actually set up is a family bank. Now, this is set up by one, you set up the insurance policy. This is the easy part. The life insurance policy is easy. The life insurance is what funds the trust, your estate plan, you know, when you pass on. By the way, just having an insurance policy also means you spend money differently when you're alive, because the fact that I know I have like $6 million of life insurance on myself, the great thing is I know if I ever die, who cares if I have a mortgage or not, that I can now make more money off of while I'm alive because it's dirt cheap at 2.75% interest. I can let that mortgage not be paid off because I know the life insurance will pay it off if I ever die. Right. So I've got that and then some to pay off. I can spend my money differently. I've actually had clients get a reverse mortgage in their older years because they know if they ever want to pay off the house, they let the life insurance pay it off after they die. So their family gets the house free and clear. Right. That kind of stuff. So anyways, set up your policies, number one. Two is build your own wealth in the meantime and teach your children how to do the same. This is the most important part of the process. More important than even the estate plan. Even though the estate plan is necessary too, you got to set up the right trusts, the living trust and things like that to help with it. That's the key to making this work. So that here's what happens. You buy policies on you, your spouse, your children, and it pays into the family trust. So when you pass away, the money pays into the trust, and then you decide how that money gets used, rather than just creating a bunch of trust fund babies and giving them money that they may not be ready for. Instead, you can create a plan that says, no. If you want to get to some of this money, and maybe you still give some money to them, but maybe you want to keep a lot of that money still growing in there. You might say, no, if you're going to get access to the money from the trust, you got to borrow it and then pay it back with interest. Don't even have to use life insurance. By the way, this is cash in it because the life insurance paid into it. And then, of course, they can come borrow from it. I'll use this example. General Electric, GE. Guys, remember them? They brought good things to life. For those of you old enough to remember those commercials. GE did the same thing to pay their employee pensions. With every employee that they brought on. Remember, this is back in the days when they try to get people working for 30, 40 years. When they came on, they would buy a life insurance policy on the employee. They would fund it. They would put money into it. And then when the employee retired, they would use the cash value. Remember, like we talked about here earlier, they would use that tax-free savings account to then pay their pension. Guess what? When they passed away, the death benefit would then go and replenish the pension of the fund so that they could do it again. They had a pension that could keep going eternally forever. Now, instead of just doing that, I know it's a pretty cool strategy. I know it's cool. So that's where they were able to keep that money growing and going. Now they got rid of pensions. They don't do that anymore, right? But that's the thing you can do with your own family bank. You can have the death benefit pay in to replenish it and let your family, when they access that money, they have to pay it back with interest so that the money doesn't deplete. They don't just blow it. They can actually use it to grow your estate bigger each year. Just to kind of let you know, Rockefeller was became the wealthiest person in the US by age 50, but at age 53, he was actually expected to die. None of the doctors could figure out what was wrong with him. He lost all of his hair. He couldn't sleep. He couldn't even smile. He could only eat soup and crackers during that time. Now, while he's in that process, he realized, man, I'm the richest man in the country and becoming the world, yet I can't even save my own life. So he made a commitment. He says, you know what? No more. I'm going to create a foundation. Why have all this money and then it does me no good? I'm going to try to give it away. He created the Rockefeller Foundation, which, by the way, actually funded the discovery of penicillin in 1941. What's interesting, though, is right after he decided to create that foundation and start to give his money away, he lived another 45 years. He lived to actually age 98. Talk about whatever you want to talk about there. But I mean, just the fact that he became it was more than just about himself. It became about giving, creating that ripple effect in other people's lives, helped essentially save his own life. And that's the thing. I love this quote from him. He says, God taught me that everything belongs to him and I'm merely a conduit to carry out his will. My life has been one long, happy holiday since then, full of work and play. He realized, guys, he was just a steward of his money. It wasn't his. You come to earth with nothing, you die with nothing. Everything in between is stewardship. He used that stewardship to create better life, not just for himself, not just for his family to keep that money perpetuating forever, because he also taught them good principles of wealth building too. But he also was able to impact the world and save literally millions of lives. This is the picture of my dad now. He, on his 80th birthday, surprised him. We went out to Oregon to go visit him with 4 of my kids. He's not leaving me millions and millions of dollars or billions of dollars for that matter, right? But he did leave behind a legacy. He did teach me, like, Chris, your word is your bond. Be a man of integrity. Work hard. Don't half-ass anything, as he would say, right? Those kind of things. Like, he taught me those good values that I can now pass on to my children. The cool thing is I can not only pass on those values, but I can also pass on money too. So guys, the great thing is you can use this to build your wealth now and still have money to pass on later. You can enjoy your life now. You can actually build your wealth, enjoy it. You can even spend down some of your money, like I talked about using that reverse mortgage and things like that, and then still pass on money for your children as well to help give them a leg up too. Here's the thing, guys. The most dangerous risk of all is the risk of spending your life not doing what you want on the bet that you can buy yourself the freedom to do it later. our days are numbered and we don't know what that number is. My crystal ball broke a long time ago. All I know is we can do things today. So my sign says, live your life now, not tomorrow. What decisions can you make today while you can control it? What decisions can you make now to prosper your life? That's where this one strategy, this one hack can help you out. So if you're interested in learning more about this, how does that look in your situation? Here's the barcode one more time, the QR code, not the barcode. You're not at a store going beep, it's the QR code. Here it is one more time. You can use that. I'm going to open this up for questions for just a few minutes here because I see a lot of questions did come in the meantime. And then we'll go from there. So, all right, while we're doing that, let me go back and let's see. Hopefully, Louis, you got to see the picture. I see that you saw black for some reason. Okay, see, Roberto says, if I use life insurance cash value for alternative investments backed by real estate, how are the earnings taxed? Same as if you use cash from a bank? Roberto, great question. Yes, you get all the same tax benefits or taxation as you would with anything else. So really think of the money in your life insurance account. Think of it almost like really using money in savings, right? If you just pull out money from the bank, you do a real estate property, you get all the depreciation, you get all those benefits. If you're a real estate professional, you even get write-offs, you can show losses, right? If you're a business owner, use it for business purposes, you get to write off the interest that you do pay. I call that the triple dip, right? It's not just a double dip, it's a triple dip, because now you're able to get your money to pay you in two places at once, but now you actually get to write off the interest anyways, which gives you even more advantage. It gives you more net profit, even more than what I showed you when I was showing that example. So yeah, great question. Let's see. I see Valerie asked this. She says, I have a whole life policy right now with Allianz. I was diagnosed with cancer this year, but only grade 1. Would I be able to convert that to your company? So Allianz doesn't have great conversion options at all. And they don't really have whole life. They're more universal life. So most likely you don't have whole life. It's probably universal life is my guess. And so can you convert it to another policy? No, you can't convert. Not like that. It has to be, if you have a convertible term, you want it it has to convert to the same company. So that's why we try to get them with good whole life insurance companies up front, and when you get a term insurance policy, and then convert later down the road. By the way, I had somebody that converted the next month. Now, in your case, because you have had cancer within the last year, most likely they might deny it. Now, if it came out benign, if it was like some people might have skin cancer or whatever, but it was a benign tumor or something like that, you might be able to get away with it after a year or two. So it's definitely worth a try, or at least worth to look at the underwriting guidelines that we have. But there's definitely a possibility there. But yeah, you cannot convert your Allianz policy to a different company's policy. See, Antonio, you came with a follow-up question after I talked about the business write-off one. If you get 6 or 7% interest in your policy and you borrow money from it, what's the premium in points for borrowing from your policy? There's not really any points. It's just simple interest that they charge you on the policy. So the interest that they charge you is like right now, like depending on the company, they're usually between like sometimes 5 to 6.5, 7%, depending on which company you use. So usually right around 6% is pretty typical right now. So you just pay interest. There's no like extra points up front, no extra interest or extra fees. That's one question I get a lot of times. Do you get charged fees like you do when you try to get home equity line of credit? Nope, no fees. It's just simple interest. That's it. So by the way, for those of you that can't scan the QR code, here's the actual link you can use there, the calendly.com link. You might take a screenshot of that or whatever if you're having a hard time getting the code to work. So let me move on to find other questions. Let's see. Oh, here we go. Oh, this is a good one from Terry here. It says, what are the factors that affect how much one should put into a policy initially? So that's a great question. Usually it's based on cash flow, Terry. It's based on the situation. Like, for example, if you're putting away, if someone's saying, I'm saving $20,000 a year in my 401k right now. Okay, cool. Well, that means you probably take $20,000 a year. I probably wouldn't set it at $20,000 a year if that's all you could possibly save. If that's the max amount you could save, I usually go less. So give you an example, if it's $20,000 a year, I might look at like $15,000 or $16,000 a year as a max contribution. And this is key, guys. This is one of the difference that we have in our policies versus others, is that there's a wide range of contribution you can do. The higher the death benefit, the more you can put in, right? So we design it to where you can always pay less, but you can never pay more than the max that's set. So if I set that max at $15,000 or $16,000 a year, that is the most you can contribute each year. You try to put in a penny or two more than that, it will trigger taxes on any gains. So we don't want to do that, right? But the minimum on that 15 or 16,000, depending on your age and health rating, is probably going to be in the ballpark of around maybe $4,000 a year as a minimum contribution requirement. So if you have that, say, 16,000 a year max you're putting in, it may only require you to put in 3,000 or 4,000 a year that you're actually required to put in. So you could put in up to 16,000, but you're not required to do that, even if it shows you on those numbers each year. So that's one thing that's nice. So if you ever have a year where maybe things are a little bit tight, you might say, I can't do 16,000 this year, but I could do 6,000. Well, great. That's more than your 3,000 or 4,000 minimum. Put in 6,000. And if the next year things get better, guess what? You can do catch-up contributions. You can put in the 16,000 for that next year and another 10,000 that you didn't pay the previous year on top for a total of 26,000. So you can be very flexible with this. And the nice thing is too, is the way we set it up, because especially if you use it more like using your emergency fund those first few years, it's very, very hard for these to blow up. The only way I've seen people lose their policies is if in the first year they dump the money in, they pull all the available cash they can out in that first year, and then the second year they pay nothing towards it. That's where you will lose it, obviously. So, but for the most part, I've had people that put money in, and then for the last couple of years in a row, especially when the real estate got pretty nasty for some people, last couple of years in a row, they've literally borrowed from their policy to pay their premiums, which is kind of cool because it's like pulling out of savings to put back into savings. So even though they borrow from the policy against using that as collateral for the policy, the money's still in there, of course, but now they're putting additional money in. So they have the loan on it, but they also have the money they put right in there to add to the cash, which grows it, which means they kind of net the same. They still have the same or more each year, even though they paid none of their own cash out of pocket. So it's pretty cool when you see that kind of stuff happen. Let's see. Here's another follow-up question. Is there still a time to set up a policy before year end to dump some money? A good thing, Antonio. When can you set up a policy before the end of the year? Yes. The great thing is it's not based on calendar years. It's all based on your birthday. And this is the key thing. If your birthday is coming up very soon, we may want to do it sooner than later because we can backdate it to keep you at the current age. Otherwise, insurance companies always round up to the nearest year, trying to make you a year older. So sometimes we can backdate it earlier into 2024 so that you can get a lower insurance cost coming out of it. So yes, there's still time, but even if you don't do it by the end of the year, again, it's not based on that, it's based on your birthday. Let's see what happens in the free consult, Jessica. Best prepare for it. The free consult, really, we talk about like what kind of numbers, really running the numbers so you can actually see it. I always realize that's the best thing is to see what does your specific situation look like. So a lot of times people say, yeah, but what would it look like if I put in, a max of 5,000 a year or 10,000 a year? Or what if I put in 100,000 a year? What does it look like? That's exactly what we do. We actually run the numbers real time. Unlike some people that do deceptive practices where they say, I'll run you the numbers after you get the approval from the insurance company. So you never see any numbers. They do that on purpose. And I know some of you have seen this before. They do it on purpose because if you get approved, they'll say, hey, the numbers came back, here they are, but you don't have to go through this whole lengthy process again. So just do the policy with us. And so it doesn't give you any time to shop for it because they say there's a deadline, you got to get it done before they pull the offer off the table. It's kind of like going to a bank and trying to get a mortgage, and they don't tell you what the rate you're going to get until after you get approved for the mortgage. And they say, well, you can go do another mortgage, but you're going to have to go through this whole process again. Just so you know, we do have an easier process. There's an accelerated underwriting for people that are of decent health, where you may not even have to get a medical exam, like a nurse coming to your house at all. You can actually, I get approved currently. I get approved in about 24 hours. So I don't even have to get a medical exam because I have very little medical history because my doctor died of cancer 8 years ago. So that tells you, I don't even have a family doctor to even go to. So just because I've been in good health. So if you're in a similar situation where you've been in good health, no big issues, you could probably get approved within a day or two. Okay, follow-up question. You have minimum contribution. You do that into the year. Can you max out your contribution? Yeah, so I kind of answered that, didn't I? It's like, yeah, even if you do the minimum, you can catch up later. You have about 2 years to do catch up. After the 2 years, then you don't get to. Here's the example. Drop 12,000 year one. Yeah, I kind of give that example too. So anyways, I appreciate your time, guys. I wanted to do this in under an hour, and it just was barely under an hour. If you have any questions, of course, there it is. There's the consult you can do there. But remember, guys, like we want to make sure we serve you the best, and get the best for you. And so if you're looking for a way to get your money to work harder, you want to be able to shave off literally years by having more interest be paid to you than you would just keep it in a bank. This is definitely a strategy you should be looking into. So again, if you guys want to reach out to us, appreciate it. Thank you as well. I see a lot of thanks coming in. So appreciate your time, guys, and we'll talk to you later.